Hi everyone, this is Kevin Kincaid and I'll be your host for today's webinar, Low Down Payment Mortgages, Understanding the Costs and Avoiding the Hidden Pitfalls. The presenter today is Andy May, Chief Operating Officer of Fha Mortgage Services. We have a few slides for you today and we'll be talking for about 20 to 30 minutes. And then Andy will answer any questions you have. Please ask your questions by typing them into the questions block on your screen at any time. This monthly webinar series is brought to you by Fha Mortgage Services, LLC, a wholly owned subsidiary of Fha, offering a full spectrum of mortgage products to the military community. Currently, we conduct business in Connecticut, Florida, Maryland, North Carolina, and Virginia. We will continue to expand to more states across the country in the months ahead. The Aqua Mortgage Services team consists of state-licensed loan officers. Among all of our professionals, we have decades of both military and industry experience. As state-licensed loan officers, we are required to provide a fiduciary level of care to our clients, meaning we must always act in your best interest when you work with Aqua Mortgage Services. We are an equal housing opportunity lender, and for your record, our NMLS number is 1423968. As a wholly owned subsidiary of Fha, we operate with the same values and priorities of our parent company. Fha stands for American Armed Forces Mutual Aid Association and is the longest standing not-for-profit financial solutions association that empowers military families with affordable financial solutions. We accomplish this by being the premier provider of affordable life insurance, expert investment management, customized retail mortgages, and our exclusive survivor assistance services, all for the military community, not for profit. This presentation is educational. It is for general information only and is not specific investment, legal, or tax advice for any of you individually. Do not rely on this presentation alone to guide your own purchase decisions. Since each individual situation is unique, the type of loan that benefits you the most will not necessarily be the same as another current or former service member. For individual advice, please contact us directly. We produce this webinar series in-house with our own professional staff as a service to our members and to help them better understand the resources that are available to them. Now I will go ahead and turn it over to Andy May to get the presentation started.
Well, thanks very much, Kevin. I appreciate everyone's time this morning. Today's topic, what is low down payment mortgage and what are the costs and hidden pitfalls? Before I define it, last year we had a $2 trillion mortgage market, and it's a dynamic market. There's a lot of options for members, and we thought that it was important to go through the options for those that are seeking low down payment mortgages. At Fha Mortgage Services, we offer all these products that you see on page 4. We offer the VA loan, Veterans Administration, to 100% financing. We offer the Federal Housing Administration, FHA loan, and that's 3.5% down payment or a 96.5% loan financing. We also offer Fannie and Freddie and the United States Department of Agriculture. Fannie and Freddie go up to 97% loan to value at this point in time. From time to time, they change. They've been as low as 95 over the last few decades, and now they're back at 97. And then the United States Department of Agriculture has been offering a 30-year fixed mortgage since about 1992. And they have an excellent program, and it's 100% financing. So those are what we're defining as the low down payment mortgage set, and that's what we'll be discussing. And as I stated, we offer all of those products. So if we turn to the next slide, we'll go through the costs of a Veterans Administration mortgage. We offer this product to all of our customers. We also compare and contrast the VA loan vis-a-vis the other options that we just discussed. and find the best option for you. Some of some of our competitors in the marketplace only offer a VA loan to the military, and we believe that is not doing you a good service, because what we find is 1 in 3 people opt for the VA loan. 2 in 3, when presented the options, opt for an alternative to the VA loan. It's a great loan. We do quite a bit of business in the VA, and as you can see here, interest rates or fees that the VA charges, their interest rate is very competitive. It's typically 3/8 of a point below what Fannie and Freddie charge, but as you can see from this slide, the cost to the veteran can be substantial, as high as 3.3% in fees. So if you've used your VA eligibility before and you do not have a disability, and we've checked your certificate of eligibility to determine what your VA fees are, they can be as high as 3.3%. So it's vital that when you're reviewing your options to get a low down payment mortgage, that you compare and contrast the VA loan with the other loans that we've discussed here so far. So again, VA does 100% financing, and you can do something known as seller concessions. The seller can make a concession or a contribution to the purchase up to 3%, and that can offset your closing costs. We do have access to the VA databases. Again, we'd be happy to check your certificate of eligibility for you. There's no charge for the work that we provide you unless we close the loan. So we're more than happy to provide a transparent experience for you. The last bullet point on this slide talks about how sellers are currently, not in every market, but in a lot of markets, they're refusing to allow a VA loan. We've seen that in Virginia, we've seen it in North Carolina, and we've seen it in Florida. Some sellers just won't even entertain it. They turn the offer down and will not allow a VA loan. And the reason being is that, particularly if you're building new construction, if the appraised value comes in lower than the purchase price, then the VA requires that the seller return the due diligence and earnest monies to the buyer. And so a seller does not want to lose the money that they've collected from you. And so we've seen a number of instances where the seller just turns the VA offer down. And we have spoken about due diligence and earnest money in the past. For those of you that have not bought a home in the last 5 years, that's relatively, due diligence money is definitely new. Earnest monies are at risk now, whereas beyond 5 years ago, you could always receive your money back. Now, the due diligence money and earnest monies are at risk. So that's one reason why sellers don't accept the VA, because the seller has to return that money to the buyer if it does not appraise. So if we'll turn to the next slide, talking a little bit about the costs of an FHA mortgage. These fees change all the time, so it's important to speak with a state licensed mortgage loan officer and make sure that you're up to date on what the fees are. And with the recent administration, we were going to see an FHA reduction in fees, but that changed. And so these are the current fees for an FHA loan. As stated earlier, it's a 96.5% loan to value, and FHA charges a 1.75% upfront fee, as well as a 0.85% fee per year. That gets pretty expensive because FHA does not allow you to cancel the mortgage insurance at this time. Previous years in the past, they've allowed cancellation, but there's no more cancellation. So over a 10-year period of time, you can see that you're going to be paying almost 10%, 10.25% in fees times the entire loan balance, and that is an awful lot of money. So FHA typically is for people now with poorer credit, and there are other options in the marketplace if you've got good credit. And so people still do request an FHA mortgage, but usually it's for consumers with below 700 credit scores. So if we'll turn to the conventional mortgage slide. Conventional is Fannie and Freddie, and they are similar in that they offer the 30-year fix just like all the other companies do. They also have ARMs, adjustable rate mortgages, and they're very competitive. They have historically controlled approximately 60% of the $2 trillion market that we had last year. They sometimes control more. Rarely do they control less than half of the entire mortgage industry. So we like Fannie and Freddie. We think that they're a great option, particularly if you have a down payment. The 97% loan-to-value product is a 3% down payment, and mortgage insurance premium rates that are added to your coupon are as little as 0.55. And as you can remember from the FHA slide, there's no upfront fee with that, and it's substantially lower than FHA, and yet the loan value is slightly higher. So it's an excellent alternative to FHA. It also is a great alternative to a VA loan for those that have down payments. And the mortgage insurance premium changes depending on your down payment. If you have a 15% down payment, the mortgage insurance premium gets down to as little as 0.18%. So we highly recommend that you look at all your options. And additionally, if you go below 90% loan to value, you can have 6% seller concessions. And again, the seller concession is the seller making a contribution to the buyer to offset closing costs and escrows. So that is the conventional loan program for high loan to value products. And the next one is the U.S. Department of Agriculture. And we love this loan here. We think it's an excellent alternative for somebody who has no down payment. And with this program, not a lot of people talk about it because it is a little bit more complicated, even more so than a VA loan, which I would say out of the 3 loans we've looked at so far is probably the most complicated so far in terms of the underwrite. But with a USDA mortgage, the property is underwritten and then the consumer or member is underwritten, and both have to qualify. And so it is for, as of October 1st, 2016, the cost is a 1% upfront fee plus a 0.35% fee per year. And seller concessions may be substantially higher than the 3%. And surprisingly, if you get a higher appraised value than the purchase price, you can finance higher than the 100%. And I think the highest we've seen is 109% was financed into the loan. So USDA is a great alternative. The interest rate is similar to VA, and it's an alternative that people should think about, particularly in the rural markets, which is where it's designed to perform the best. So those are the 4 overall mortgage products that we were going to talk about today. The next slide, we talk a little bit about the pitfalls. We've already mentioned how the seller in a transaction, we've seen a lot of instances, and there's been a lot of articles written about how sellers are not allowing buyers to offer an offer on their property if it's contingent on VA financing. And we'd be happy to discuss this with you as you go through with your realtor. I highly recommend that you speak to a state licensed mortgage officer, loan officer, before you speak to a realtor. We are your fiduciary. With a realtor, once you sign the broker agreement, your fiduciary, their fiduciary responsibility converts into contractual law. So they're not necessarily as high a fiduciary level as we are. We are more than happy to run through broker broker agreements and making sure that there are no hidden fees in them. We've seen broker agreements with your realtor when you sign them that you wind up paying a $750 fee to the owner of the realty firm and things like that. We highly recommend that you speak to us before signing a contract with a broker, a realtor broker. And additionally, some of the realtors share their commission with some of our competitors, which has proven to be not exactly forthright because you, the consumer, do not know about that in all instances. And so we recommend chatting with us before hiring a realtor. So additionally, one of the hidden pitfalls is that the buyer may run out of money as they make an offer on multiple properties. For each property you make an offer, you write a due diligence check that the seller cashes and keeps, and then you also have an earnest money check. You have inspection fees, appraisal fees, etc., and the cost of that can run above $5,000. So if you make an offer on one house, lose it, move to the next house, you can be out $10,000 and still not necessarily have the home that you wanted. So understanding your costs up front, we can pre-qualify you, give you a loan estimate, and show you exactly what your costs are going to be. I highly recommend that in order to avoid losing a lot of money in the process. We've got down here that you should also have a reserve for air conditioning and heating. We think that's very important, and we also supply 1 year of filters for your air conditioner. Just to remind our members, we send you a couple of filters, and we just want to remind you air conditioning and heating is expensive and very important for a low down payment mortgage consumer, to make sure that you understand that. Then the last point here we talked about, when you enter a buyer's agency agreement or a realty broker agreement, make sure that they've fully disclosed the fees. As I said, we recently saw a realtor charge $750. A lot of them charge $500, and that's kind of just an extra junk fee that goes to the owner of the realty firm. There are also hidden controlled business arrangements or marketing service agreements, and we've written extensively on that. If you want to type in CBA and AAFMAA or controlled business arrangement and AAFMAA, you'll find some of the articles we've written about it. But when other people are getting paid and you're not aware of it, it's never in your best interests. So we highly recommend that you understand the way monies flow through the transaction. And in AAFMAA Mortgage, we're here to make this process as transparent as possible for you. We welcome your questions. We welcome working with you. Even if you are already working with another lender, give us a call. We'll at least try to help you out, make sure that that other lender is behaving in a fiduciary manner. So with that, I will turn it back over to Kevin Kincaid, and appreciate your time.
Great. Thanks again, Andy. That was a great and very insightful presentation. I appreciate that. We're now going to open it up for questions. We've collected a few already, but please, again, don't hesitate to ask others by typing them into the questions block on your screen. As the Chief Operating Officer, Andy oversees all transactions of AAFMAA Mortgage Services, which is headquartered in Fayetteville, North Carolina. So looking at our questions, Andy, the first question is, I've heard about piggyback mortgages. How do they compare?
Well, piggyback mortgages are a two-loan structure. The first loan is an 80% loan to value, and then the second loan is a home equity line of credit, typically, that comes with an unlimited interest rate in many instances. So they compare favorably in helping you lower your PMI costs historically. And so they became very prevalent in the 1990s when PMI costs, or private mortgage insurance costs, were substantially higher. So on a Fannie Mae loan, We were just talking about a 97% loan to value costing 0.55. During the 1990s, that same loan cost 1.25. So the cost of PMI has dropped precipitously, and piggyback loans have kind of gone away. Additionally, banks got into an awful lot of trouble. They don't normally operate with the same discipline as an insurance company. And so banks were doing a first lien of 80% and a second lien of 20% or more, and then trying to get people down into the 600 credit score area. And they lost their shirts, as we all read about and have seen. So piggybacks are still out there if you're presented with one. It is a complicated process. There are a lot more hidden pitfalls with it. It does affect your credit rating negatively when you obtain that second lien. So we highly recommend you chat with us before entering into a piggyback loan structure. But again, it's good to know about them because in the past they've been successful. Right now they're not so successful, but it's something to be aware of. Thanks. That's a good question, Ted.
Great. The next one is how much time does it take to underwrite these different low down payment mortgages?
Well, the Fannie Mae and Freddie Mac loans are the fastest to underwrite. We have closed people in as little as 12 days, and there's under all the new TRID guidelines and under the new compliance guidelines, there's waiting periods and cooling off periods and all kinds of different things that have to go on that in the past you could close a loan in 3 days. You can no longer do that legally, not with a normal safe harbor loan. And a safe harbor loan is just a loan that is Fannie Freddie compliant. And so we can close them in about 12 days on the fastest. I wouldn't suggest everybody write that date down. If you've got all your documents together and you're really, really sharp, 12 days. But if the standard person is closer to 30 days with a Fannie Freddie loan, and with a VA loan or an FHA loan, it takes substantially longer than that. So the VA is easily a 45-day closing, sometimes 60 days. So be aware of which loan program you're in so you can make your accommodations for housing match your needs. That's a great question.
And Andy, I know I mentioned the states that we're licensed in currently. We've had a couple of questions about specific states. Can you share with us not only the states that we're currently licensed in, but any of the planned expansion that we can talk about at this point?
Absolutely. Now, the banking commissioners in each of the states do not allow us to pre-sell and talk about, come to our state in the near future. So from a liability standpoint, it's best that we don't go into a lot of details. I will state that, North Carolina, Virginia, Florida, Connecticut, Maryland, we are licensed. And I can tell you that we are in the process and we're waiting approval from an additional 8 states at this time. So I can't tell you which 8 those are because of banking laws, but we continue to expand and we're looking forward to being in your state soon.
Got it. Great. One other question. We talked a lot about VA loan program. Obviously, it's important to our target audience, but we also talked about how that's not always the best option. We have a question. If my VA loan has been reinstated, is this a good way to go? Would I have to pay for mortgage insurance?
Well, the VA does not charge mortgage insurance per se. They charge a fee, and it's a funding fee. And what we would do is check your certificate of eligibility to determine the actual charge that you would receive. If you have any kind of service medals like Bronze Star or Purple Heart or any kind of an award, that also reduces your fee. So rather than what we recommend people do is we'll log into the VA portal and we'll find out exactly what your cost is. If you're being reinstated, chances are that's a good option, but any individual, we would prefer to see a full package of information rather than just trying to take a look at one angle on it. But the VA is a lower interest rate option, particularly for the 100% financing, and typically it is a very good option, but not everybody has the disability and not everybody can waive the fee that the VA charges. So we found just looking at all the options is a smart way of going about getting financing for 30 years.
Great. Couple more coming in now, which is great. Thanks again for the questions. If you have any questions, if you think of anything, feel free to write them in the questions block. Here's an interesting one, Andy. If I bought a house about a year ago with a 20% down payment, would it make sense for me to refinance at this point? Have interest rates gone down since then?
That's a great question. Interest rates have actually gone up by almost 1 full percentage point. In fact, I got my AAFMAA mortgage about a year ago and got a 3% interest rate on it for 15 years. With interest rates today, the 30-year interest rate, and obviously this is not a quote, but it's generally in the 4.125 to 4.25% area. And we do not charge any direct fees. You pay third-party fees, so there's no like 1% loan origination fee. So I would say if you originated your loan a year ago, it does not make sense to refinance unless your credit has improved substantially and you were in a subprime or a high interest rate loan.
Great. A couple more questions coming in, which is great. You talked a little bit about the USDA loan and what a great program that is. What are the two factors that determine approval, and are these more for rural focused properties?
Yes, and if I didn't enunciate that loudly enough, it is more for rural properties. It's the United States Department of Agriculture came out with a program around 1992, and a lot of lenders don't like it. In fact, a lot of lenders don't offer all these products. They like to specialize in just a VA loan, or they like to specialize in just Fannie Freddie loans. In fact, some of the largest banks in the country don't offer FHA, or some of them don't offer Fannie Mae and Freddie Mac. So it's kind of crazy how not all of the programs are offered by a lot of these competitors. We believe it's our obligation to you to make sure that these programs are available to you, because interest rates on them do change every single day, and so do the costs associated with them. And with the USDA loan, you have to qualify the property to make sure that you are indeed in a rural location. And for many of our service members around the bases, that's USDA's prime market locations. If you're living in the bigger cities, maybe not so much in terms of USDA. Surprisingly, in the Raleigh area, USDA goes right up to the airport. So you have to look at their mapping software, and we can look at that for you and find out if the property that you found qualifies for USDA financing. And that's kind of hard for a consumer to do, to navigate the USDA's website and find exactly where this location is. We'd be happy to do it for you and let you know if your property qualifies. Then the other thing is that you need to qualify. And you need to qualify in terms of credit score and assets and things like that. But you also need to qualify in terms of income. So you can't make too much income, which is kind of an oxymoron. You wouldn't think they'd have that as a requirement. But generally speaking, if you make more than $130,000, chances are you're not going to qualify for the USDA loan. But that's a great question. USDA is more rural. The definition of rural is based on their mapping software, and it changes all the time. So highly recommend the call just to check, see if your property is eligible.
Great. A couple more coming in, and here's actually two different questions, but sort of in the same realm. So maybe you can answer them together. But is it in any way more difficult to get a mortgage if you are retired, if you're fully retired? And is there a fee waiver for veterans with 100% disability?
Well, the fee waiver on the disability, 100%, almost always is a waiver. So if you're 100% disabled, generally speaking, it's almost always waived. So that's an easy one. As far as the retirement income, it used to be that the lending environment favored assets, and we could look at your assets and say, you know what, we don't care if you don't have a job, we're going to fund that loan. With the recent meltdown that we had about 8 years ago, they changed all that, and they said, even if you have $3 million in checking, we're going to make it incredibly difficult for you to qualify if you don't have a job. So, people would go out, get a job at any company and say, okay, I've got my job, and then they'd qualify. With retirement, it's a little different. They will count your retirement income, but you have to prove that it's from a source that is going to continue for at least 3 years. So if you can do that and you've collected your first check, then we can start to work on qualifying you. But they become a little bit more relaxed for retirees than they were 8 years ago. 8 years ago, they'd say, well, you have to wait 3 months, collect your money for 3 months in retirement, and then source all of your income. And now they're a little less stringent in the underwriting process. But those are two great questions. Obviously, we've hit a nice vein here in terms of low down payment mortgages for our members.
Yeah, absolutely. One more question, and I think we'll be out of time. But I know that you spoke a little bit about why someone would choose an FHA mortgage, usually based on a lower credit score because of the fees. If I have a pretty good credit score, maybe about 700, does it make any sense for me to even think about the FHA loan? Should I just think about conventional? And how do the fees compare between the two? Because sometimes it seems like they end up costing about the same.
Yeah, and at 700, you're really on the bubble. It used to be that a 700 credit score was considered phenomenal, excellent, in the top in the country, but they've watered credit scores down now so much that a 700 credit score is considered kind of middle of the road now, like maybe the 50th percentile. So how that pricing compares for a 700 credit score is really important to understand, because if you go Fannie Freddie, they charge you more for having only a 700 credit score. 760 is their premier credit score. 700, you're going to get a bigger charge on Fannie or Freddie. With FHA, the FHA allows for a wider debt-to-income ratio than Fannie or Freddie, so if you have a lot more debts, people start to migrate toward the FHA loan. Now remember, there are a lot of competitors out there that only offer one loan program, and that's a real problem for you if you're a 700 credit score, because you're on the bubble. You need to look at all the different options, and it's very unique to your personal circumstances.
Great. And I know I said that would be the last one, but we actually got a really good one just now, and we'll finish up with this one. I know, Andy, you mentioned that one of the challenges with the VA loan can often be a longer close time. Are there any other closing pitfalls that we should know about for the VA loan in particular?
Well, there are. We've run into a number of different situations, and rather than go through each and every one of them, I will say that we've got a great staff, and we can ask the VA, which a lot of lenders don't do, for exceptions. For example, if you have a swimming pool, you have to have a fence around it. And some locations, particularly rural, there are ways to get an exception on a fence around a swimming pool. But most lenders just simply say, no, you got to put the fence up. At AAFMAA Mortgage, we've got a great staff of people who have served and who have worked with the VA for decades. And we can work with you through a lot of these different issues that come up. Again, I think the biggest one is simple marketability. The VA loan can be an unbelievable product for you. And you go out to build a house, or you go out to buy a house, and the seller says, I'm sorry, I'm not going to accept that great interest rate for you. You're going to have to pay more to buy this house. And I think that's unfortunate. But just be very cognizant of that and make sure you've got a team behind you that is transparent and trying to help you out through this process.
Great. Thanks again, Andy. Those were some great questions. If we didn't fully answer your question, or if you think of another question later, please feel free to reach out to us at mortgage@afma.com. We'll go ahead and break here for now, but you can reach us whenever you need to. Please don't hesitate to reach out and ask for help. We do this every day for our military community, and it is our pleasure. This weekend, you'll receive a follow-up email with instructions on how to access a recording of this presentation. And you can always sign up for future webinars or review past webinars at afma.com/webinars. Speaking of future webinars, be sure to join AAFMAA Wealth Management and Trust Business Development Officer Mike Milligan on April 13th for their next webinar, where he will discuss the Department of Labor's fiduciary rule and what it means for your future. As a reminder, just like we mentioned earlier about AAFMAA Mortgage Services state licensed loan officers, as a chartered trust company, AAFMAA Wealth Management Trust is a fiduciary and is required by law to always act in your best interest, and that's not true for all investment managers. Should be a great discussion, and we hope you will join us then on April 13th. If you found this information useful, please share it with your friends and family. Our membership grows stronger every year because you introduce your eligible friends to AAFMAA. Thank you again for joining us today, and we look forward to our next opportunity to serve you.